Most people think more accounts automatically means stronger credit. That is not how lenders evaluate it. They don't just count how many accounts you have. They look at how those accounts are arranged. Two people can have the same credit score. One has 3 accounts, the other has 12. Those profiles do not look the same inside underwriting systems. This is where account distribution comes in. Account distribution simply means how many accounts you have, what types they are, how they are spread across credit cards and loans, how balanced or concentrated your profile appears. It is not about having a lot. It is about how the structure reads. Imagine a profile with only one credit card. Even if it's paid on time, the system has limited data to evaluate. Now imagine a profile with multiple accounts. If those accounts are balanced across types and ages, the system sees more history. More history means more data. More data means more stability signals. But there is another side to this. If someone has many accounts opened close together or many accounts carrying balances at once, that can create structural density. Structural density simply means how tightly packed your credit activity appears. Too little density can look thin. Too much density can look stretched. Lenders evaluate both. If someone has only 2 accounts and both carry high balances, the profile may look concentrated. If someone has 10 accounts and most are near their limits, the profile may look extended. In both cases, it is not the number alone that matters. It is how the distribution reads as a whole. Account distribution is about spread. Spread across types. Spread across time. Spread across balances. A balanced spread often signals stability. A concentrated spread can raise questions. For example, if most of your available credit exists on one card, that card carries more weight in evaluation. If your balances are evenly distributed across multiple lines, risk may appear more dispersed. There is also something else lenders quietly evaluate: dependence. If one account were removed tomorrow, would the structure still look stable, or would everything rely on that single account? If your profile depends heavily on 1 or 2 accounts, that creates concentration. If your history is supported across several independent accounts, the system sees durability. Durability means your structure can absorb change without dramatic instability. That matters, because lenders are not just evaluating today. They are evaluating how steady your profile appears over time. This is why 2 people with similar scores can receive different approval outcomes. Their structures are different. One may have a thicker profile with more distributed history. The other may have a thinner profile with limited data points. Lenders do not evaluate effort. They evaluate patterns inside structure. Account distribution effects, data depth, balance spread, type diversity, concentration risk. All of that contributes to perceived stability. There is one more thing to understand. Account distribution does not change overnight. It builds slowly. Every new account shifts the structure. Every closed account reshapes the layout. Over time, your file forms a pattern of depth or limitation. That pattern influences how confident a lender feels when evaluating you. This is layer 2, structural positioning, not behavior, not timing, not risk modeling. Structure. Before lenders interpret timing, before they combine layers, before they assign probability, they evaluate what is physically present in the file, how many accounts exist, how they are arranged, how concentrated exposure appears. That arrangement becomes the foundation for everything else. Understanding distribution removes confusion because sometimes nothing is wrong. The structure is simply being interpreted differently. Clarity builds confidence. Consistency builds approval strength.